Hey everybody, Boris Hauser, BK Force. Welcome to our Force Weekly Technicals for 7/28/081 of 2014. Where are the trades? Well, interesting week this week. We had the euro finally expand a little bit of its volatility as we start to move downward on relative growth concerns. Clearly, the eurozone is starting to slow down significantly. The PMI data this week actually was not that bad in the eurozone, but clearly the market is very concerned about the future problems with Russia and the fact that that could create more of a slowdown, especially against Germany in Q3 of this year, while the U.S. data still continues to be relatively robust. So you have this differential now starting to take place much more. And you see, after we cracked the 3,500 level last week, it finally started to really buckle, and we're now trading within essentially 30 pips of the 34 level. Looking out a little bit further, there is support here. I don't think it's going to be easy slide much further. So you have the 34 support here from around November, and you have the 33, 50, 33 support essentially from early November. Those are the spike lows from 2013, and then of course the absolute yearly low comes in around September. Around, where's the low here? Around 31. So yes, there's potential here to slide all the way down to potentially a double bottom around 3,100, which frankly would probably be the fair market value of the euro on a fundamental basis. But I do think it's a very, very slow stutter step move. Although I think what's interesting here from a technical point of view is that after, and let's zero in on this, after all of this kind of back and forth, back and forth, back and forth consolidation, counter trend rallies, what you see here technically is that the counter trend rallies have become weaker and weaker, which suggests that the downward momentum, the market is becoming more and more convinced that this is the way to go to the downside. So for now, actually, the downward momentum could potentially accelerate, even though it looks like we've come in about 250 points off the highs, simply because you don't see any counter trend moves of any significance. There's just basically what this is showing you technically is that there's just nobody wants to buy the euro right now. So for the time being, it's a sell the rallies, sell the breaks story, and I do think if we break the 34s. We may have a counter trend rally back up 3450, but essentially we have a potential here to certainly test 3350, 3300 as the first initial bottom, and then lastly, you have the 3100, perhaps as we go into September and October. So euro is starting to open up to the downside in a more forceful fashion, and unless we get some sort of happy resolution, Russia starts to chill a little bit politically, and everybody begins to feel better, or we get something surprisingly weak out of the U.S. and euro starts to again get the flows back on a relative strength basis, which is highly unlikely. But nothing can be ruled out in the marketplace. The counter trend rallies really don't seem to be very significant. Bottom line is, when you look at this technically right now, you have to trust the fact that there are no buyers in the euro, and the path of least resistance is to the downside, and I think that's kind of very interesting. Dollar yen, on the other hand, just showing a modicum of strength. We've, for the 50th time this year, discussed the fact that this 101 level has held. Of course, the longer the base holds, technically, the stronger the possibility of an upside breakout. But this all is contingent on the idea that essentially U.S. rates will finally begin to move up. And this is obviously contingent on the idea that the recovery picks up steam, doesn't stall out. And I think the question to that is still very much an open question as we go forward. But for now, with U.S. yields stabilized at 2.5, and we've basically tested 2.5 2 or 3 times over the last month and a half, and just held. Similarly, we've tested the 101s in dollar yen, and in many ways, this correlation with a 2.5 on a 10-year yield and the 101 on the dollar yen is probably the primary correlation in this currency pair. So we start breaking up higher. We have the NFPs this week. If the NFPs prove to be as robust as everybody expects them to be, I think let me see what the expectation is, probably around 200,000. Let me see what the number is looking for. The market is looking for 230. The market is looking for 230, a little bit lower than last month at 288. But regardless, if we print above 200,000, that should be good enough to maintain the yields at these levels. And if we can start to inch our way towards 265 on a 10-year yield, that really opens up the prospect of 102, 103. For dollar yen right now, essentially on a technical basis, we need to hold 102 on a closing basis and stay above it. If we close above 102 on Friday, post the NFPs, that could provide the solid technical base for a rally towards the 103s, 103.50s as we go forward. So be watching dollar yen very carefully. Pound dollar rolling over. I think that's been a story that's been developing for the last. I mean, as I've showed this in the daily stories, is 1, 2, 3, 4, 5, 6, 7, essentially 8 consecutive down days. We've had a slow but very clear corrective rally in the pound. The pound does find support 69.50. We may find a little bit of a bounce here. There isn't too much news here. We only have PMI manufacturing really in cable. The story in cable of the unwind is really the story of the fact that the BOE does not plan on hiking rates in 2014. And it's probably going to just simply stay stationary. As a matter of fact, many of my colleagues from UK are telling me that really they're not going to hike rates until the election in May of 2015 it goes by. So that really leaves us basically in almost the end of the first half of 2015, which will match the BOE to the Fed in terms of the timeline, which doesn't allow the pound to have this massive outperformance. So we could be having a corrective move here. We also could be running into maybe a little bit of a slowdown in UK growth. We'll have to see how those numbers start to print over the next couple of weeks. Again, the critical thing with UK, until wages begin to catch up to inflationary pressures, you really don't have any need for the BOE to raise rates, and you're seeing the market reflect that. So from a technical point of view, we're holding the 69.50 here as the initial level of support. This was the big breakout from which we went to take the 72s, and the corrective move beyond the 69.50 here really takes us all the way down to essentially the 67.50. That's a longer term potentially unwind. But cable is notorious for doing this, where it just takes really big moves, unwinds them practically all the way to the lows. If you look at this on a yearly basis, you effectively have, so you have this move 63 to 67, and comes back down to 64. You have the next move 64 to 69, it comes back down to around 66, right? So between 2/3 and 1/3 of a correction. So now you have the move from 66 to essentially 72. And if you have 1/3 of a correction, we're pretty much there. If you have 2/3 of a correction, it's probably going to be like around 68 that we kind of bottom out, if you sort of apply the upward path that you've had in cable. Aussie is starting to roll over as well. And this is interesting because I think, Aussie has had a lot of positive flow on the idea that the RBA is not going to lower rates anytime soon. But at the same time, and this is what I think is interesting as far as the dynamic, Aussie in many ways is now starting to trade on U.S. yields. What I mean by that is if U.S. yields increase, the relative attraction of Australian dollar decreases, because we know the rates are certainly not going to go up in Australia. The only thing they can do is defend the status quo. So if the U.S. status quo starts to improve, that means if U.S. yields start to go to 65 to 70, that actually puts more downward pressure on the Australian dollar. And I think in many ways that relationship is going to be the more interesting one to watch, since the fundamental data essentially is saying that things are going to stay the same on the Australian front. There is very little Australian data for the rest of the week. It's been trading in some ways also correctively off of the Kiwi dollar flows, which I'll discuss next. But bottom line is we seem to have made perhaps a lower high over here at the 94.50s. We certainly made a very decent topping formation ahead of this 95, and a corrective move down to 93.50, not at all inconceivable, just on a technical basis as we go forward. Let's take a look at the Kiwi dollar, and then we'll take a look at the CAD. The Kiwi, big crash off of the RBNC statement, which did release a higher rate hike. But here's the interesting thing: they basically said no more all the way until March of next year. They've completely, basically, readjusted the market expectations for any further hikes. So this leaves Aussie with the highest yield in the OECD, but yield that is not going to grow any further for quite a long time, because clearly the Kiwi, because clearly the New Zealand economy is starting to feel the full brunt and weight of the high exchange rate. The RBNC was very clear about its displeasure with the current exchange rate levels. Probably would love to see this thing realistically at 80, but certainly wants to see it below 85. So I think there's the pressure here to try to push the towards the 85s will be interesting. We'll see how the front of the week trades. Actually, it'll be interesting to see if there's still, if we have any kind of an anemic counter trend rally as some bargain hunters come into the trade, or whether the shorts are going to try and press this thing all the way down to 84.50 and try to take out long-term carry traders who are clearly holding. The stops here are at 84.50, which is the longer-term positional traders that they're holding them. And we'll see if they're going to try and press this all the way down to that level. very well may be the story here on the momentum basis. Lastly, dollar CAD. We do have Canadian data coming up as well. Dollar CAD is starting to weaken as well. We bottomed out here near the yearly lows, 106, starting to come back up towards the 108, and the Canadian data not really supportive of a big expansionary move here. And I think again, the story here could be interest rate differentials. If certainly the BOC is going to remain, has clearly communicated they're going to stay stationary and stay accommodative for as long as possible. Whereas if U.S. yields begin to percolate up, we may have a move towards the 108. Really, the 108, but the 108.50, 109.50 comes in a much stronger resist level. So I think it'll be much choppier as we get through this level. But a move through to the 108, 109.50, definitely very feasible as we progress through next week. So that's how the week shapes up. Quite a lot of interesting stuff, of course, this week. It's really, in many ways, going to be a referendum on the dollar. Does the U.S. economy sustainably growing itself? Will U.S. yields finally start to lift off the 2.5% handle? And if any of those things come true, then the dollar gets the bid, the Aussie gets the sell, the euro gets the sell, the caddy gets the sell, and dollar yen perhaps moves over towards the 102s. That is the story in a nutshell. Wishing you guys the best of luck, the best of trading. Boris Schlossberg, over and out.